Nobody breaks down how to actually get to the point where you can live off your investments. I'm going to give you exactly what to do in order for you to reach your goals, no matter how crazy they may be. What I've seen after working with hundreds of people is that the people that can actually live off of their investments, live off of dividends, did something that most people are not doing. So those of you that are investing in dividend stocks, in dividend ETFs, you might be doing it wrong. Now, these dividend type videos are awesome because you can see how building up this passive income stream could literally free you from your 9-to-5 job and let you retire or give you options to be able to do whatever you actually want to do in life. It also makes it so that if you do this right, you could earn a paycheck just from your invested money and live all the way just off of that. Which means your principal stays the same or even goes up, so you should never ever run out of money and can even gift it to your heirs or charity or do something amazing with it very late down the road. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. Remember that all investing carries risks, so do your own research. This is not financial advice, and I'm not a financial advisor. Most dividend stocks or ETFs that are worth holding for any long period of time are giving a dividend of about 2.5% to about 4%. Let's say you need about $60,000 per year to cover your living expenses. First, you're going to need to consider taxes. For a traditional dividend stock or ETF, the taxes on dividends will be taxed at long-term capital gains rate, which for most is 15%. So if you need $60,000 to live off of, you actually need about $70,000 in dividends. To figure out how much you need to have invested in order to hit that number, take 100 and divide it by the dividend yield. So on a 2.5% dividend, you'd go 100 divided by 2.5, which equals 40. Then you'd multiply that number by the number you're hoping to receive in total dividends. So we want $70,000 in dividends, so it would be 40 times 70,000, which equals $2.8 million. To make sure you did the math right, take that number, $2.8 million, and multiply it by the dividend yield, which in this case was 2.5% or 0.025. And that should get you that $70,000 that you're looking for. At the high end, at 4%, something like a dividend that SCHD gives out, we divide 100 by 4, and that gives us 25. 25 times $70,000 is $1.7 million. Much better than almost $3 million, but that's still an astronomical number. In a video that I did a couple of weeks ago, I showed that you could actually live off of just $500,000. Not these crazy $2, $3, $4 million numbers. Let me show you this quick clip here from that video because understanding this is the only way you're going to be able to understand how to actually get there very, very quickly. So here's what many of my clients are doing, and it's a hybrid strategy that I've worked up. I love the consistency, reliability, and stability of those blue chip stocks and the solid blue chip ETFs that I was talking about from before. It also has a qualified dividend, so that's very important as well. For this portion, you could find 5 to 10 blue chip dividend stocks, hopefully from the Dividend Kings list here, or you can piece together 1 or 2 solid ETFs like SCHD, VYM, or FDVV. Let's say you have $500,000 total to invest. For this, I'd want about 30% in this category. So 30% of $500,000 is $150,000. On that $150,000 invested, if you chose SCHD at 3.5% dividend, you could realistically expect about $5,250 in dividends. Next would then be a category of the higher paying dividend stocks or REITs. For this, I'd want about 15% in this category. So that would be $75,000 there. On that $75,000 invested with a 7% dividend, you could realistically expect about $5,250 in dividends. Next would be the most solid covered call ETFs as possible. Like I said, my favorite right now after much research in the space is SPYI, QQQI, and even BTCI. I feel that SPYI is the least risky and BTCI is the most risky, so I'd set it up in this way. 20% to SPYI, 15% to QQQI, and 10% to BTCI. SPYI, if you put $100,000 on that, $100,000 invested with the 12% dividend, you could realistically expect about $12,000 in dividends per year. In QQQI, on that $75,000 invested with the 14.5% dividend, you could realistically expect about $10,875 in dividends. For BTCI, on that $50,000 invested with the 28% dividend, you could realistically expect about $14,000 in dividends. Last, I'd still want to keep growing that nest egg just a little bit at least so that it can keep growing, and then you'll have even more principal to be able to pull from if you do choose to have more dividends down the road. Also in the next decade, I believe that AI and technology and things of that nature are just going to keep booming. So it'd be very smart for you to make sure and have at least some exposure to it. The problem with a lot of these dividend ETFs or dividend stocks is that they're not in the technology sector, or at least not heavy in the technology sector, and so you're missing out on possible gains there. So to be diligent and smart, I'd have at least 10% of the portfolio in the S&P 500. The total dividends per year on $500,000 with that strategy would be $47,375 or $4,000 per month in passive income. So if you had $1 million saved and invested, it'd be more like $94,750 per year or almost $8,000 per month in passive income. The cool thing too is that this is highly customizable. If you wanted less risk, we could take out the BTCI fund and maybe some of the REITs and add in short-term treasury like SGOV that pays about 5% per year in dividends and keeps your money very stable, so you're extra protected. Okay, so now you know that it's possible to live off of dividends at much lower numbers. As I said near the end there, these things are highly customizable, and so if you can find somebody that you can trust, who knows how to work these strategies and might be able to help put one together solid for you specifically. This is what I do for my clients in a quick 1-hour Zoom, so if that's of interest to you, you can go ahead and email me at ProfessorG.invest@gmail.com. I also have that link down below, but if you email me, I'll send you my calendar and we can set that up. The thing that I see people do wrong is they watch videos like this and see funds like SPYI that sound amazing. They're giving out a 12% dividend. And since the goal is to have as much as possible in that SPYI or in something that's giving you a dividend of like 12%, then maybe you just start right away, even when you have a little bit of money, and you start adding to SPYI right now. Let's say at this point you don't have anything invested, you have $10,000 that you want to invest. By choosing to invest in SPYI, while yes, the dividend is around 12% per year, the capital appreciation is pretty non-existent. Remember that these covered call ETFs do a great job of producing cash flow by writing calls on the underlying asset. Like SPYI or JEPI, both have the S&P 500 as their underlying asset. QQQI or JEPQ both have the NASDAQ 100 as their underlying asset. If you're someone who has enough capital that if you just put all of that money or some of that money into SPYI or QQQI or something, and that 12% dividend is going to suffice because at this point you have $2 or $3 million to be able to put into that, then you're good. But most people are in that stage where they're trying to build up to be able to have enough capital. Most people are currently at $10,000 or $50,000, definitely not anywhere near enough principal to be able to live off of that yet. So if that's you, you're not looking to grow through dividends. You're looking for the best total return. The problem with covered call ETFs is that they're actually capping your upside. They give a good dividend, or really it's called a dispersion, but they're kind of hurting you or stunting your growth if you're in growth mode right now. Look at SPYI. The total return this year to date in 2025 is 12.5%. The total return last year in 2024 was 19%. The total return in 2023 was 18.1%. While all those are very nice returns, let's look at the actual underlying asset. Had you just invested in the S&P 500 rather than a covered call strategy on top of the S&P 500. So let's look at VOO, which tracks just the S&P 500. Total return this year to date is 14.3%. Total return in 2024 was 25%. Total return in 2023 was 26.3%. Looking at those side by side, it's pretty clear. And then looking at this chart, comparing them where blue is VOO and red is SPYI, It's even more clear at this chart comparing the two funds for the life of SPYI. So the total return is higher, meaning that your principal is going to grow faster. Also, along the way, if you're investing in a taxable brokerage, if you chose to invest in SPYI, you're going to have to pay taxes on those dispersions or dividends throughout the year. If you just invest in VU, it's very much more tax efficient and you're not having to pay very much in taxes for the dividends. The thing that's going to get you to financial freedom is actually different than the tools used while in financial freedom. So if I had $10,000 today and my goal was to eventually live off of dividends, I'd be focusing on the fastest and best total return while obviously trying to minimize my risk along the way. I'd want to hold 3 to 5 ETFs with differing levels of risk, but that also diversified the portfolio and performed better in certain market cycles, while the other part of the portfolio might perform better in other market cycles. I wouldn't be looking at a fund like QQQ or something that's done very, very well just this year now and put all of my money into something like that, because in a year like 2022, QQQ dropped negative 32.5%. If you had $1 million portfolio and it was all in QQQ, you would have lost $325,000 in 1 year with a drawdown like that. Brutal. Now it obviously depends on your age, your goals, your risk tolerance, and a bunch of other factors, but my portfolio would include one ETF that's safe and sustainable that has a lower beta than the overall market, so it's less volatile, and then also has a purely qualified dividend. I'd want to have one ETF that's the foundational ETF and that it's like a market average fund that's tried and true for over 70 years. I'd then want a couple other ETFs that have differing levels of risk, but that are in the portfolio for higher risk and possible higher reward to take advantage of the AI and technology boom incoming. So for the safe/sustainable ETF, I'd go with SCHD or VYM. For the foundational ETF, I'd go with an S&P 500 ETF like VU or SPLG or SPYI, or I'd go with a total US market ETF like VTI. For the growth ETF section, for that higher risk but possible higher reward section, I'd first go with a broad, solid growth ETF that's been around for years and years with solid performance, like QQQ, QQQM, SCHG, or VUG. Recently, I've also really liked adding in a momentum ETF here too, and my favorite is SPMO. I'll queue up a video on that at the end of this video because this is the hottest ETF that you may not know about yet, and it's something that I just recently added in my portfolio. The last type of ETF I would go with would be something that's probably the highest in risk but higher in possible reward too, so maybe a purely technology fund like VGT, or possibly a semiconductor fund like SMH, or maybe even a Bitcoin ETF like IBIT. Looking here at this chart, it shows you how much money you'd be leaving on the table by only going with a high dividend ETF to get you to your goal. The top line in blue is SMH, the semiconductor fund that's been going crazy with all this AI hype. The next line in orange is SPMO, the momentum fund. The next line in purple is VGT, the technology fund. Next is QQQM, which is the broad growth ETF. Then the dark blue, which is the S&P 500, and then in last place, way down there in red, is that SPYI high dividend ETF. Going with a portfolio mix that I just went over, rather than going with that high dividend ETF to get you there, should help you grow much, much faster and absolutely be much more tax efficient. Then down the road, when you've built it to that 500,000 or 1 million or whatever you think you need, then you can switch it over to the higher dividend style portfolio like I showed you in that first video, or that clip that I showed you from the video that I made a couple of weeks ago. To go deeper and watch that entire video and to go deeper into that strategy, watch this video here. And if you'd rather learn a little bit more about that momentum ETF SPMO, watch this video here, and this is the one that I just recently added to my portfolio, and I'm adding it in heavy over the next couple of months. Both videos are also linked down in the description below. Remember to keep investing simplified.